Local stories, local voices. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
Well, yes, this is your host, Erik Reynolds, and I'm here with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and today we are talking with Byron about Canada's economic outlook for 2014, including the U.S. Federal Reserve's effect on Canada, how investors should handle market corrections, and the sort of returns investors can expect in 2014. Now, before Byron joins us, just a reminder that if you have questions or require assistance, you can reach Byron at 604-535-3700. That's 604-535-3700. Well, Byron, it's great to be talking with you today.
Glad to be here, Erik.
Yeah, and just like always, let's just jump straight into it. Let me ask you this question. So now that we've started off the new year, what is your economic outlook for Canada in 2014?
Well, let me sort of try to set the stage to work up to an answer to that. Definitely the U.S. continues to be the center of the global economy, and the good news that we're hearing from the consensus thinking from economists is that they expect the U.S. economy to continue to recover in 2014. The consensus real GDP, which is the gross domestic product forecast for the U.S., is 3%, which actually is the highest following the recession we've just been through. We do see slower to a little bit more moderate growth for Canada this year. We have a slowing housing market, we have weaker consumer spending, and with record high levels of consumer debt in Canada, that's likely to create a few potential headwinds for the Canadian economy. Now, of course, slowing resource demand around the world will also weaken the Canadian economy, which is why the Bank of Canada has engineered a lower dollar. So I would say the ray of sunshine is that with a stronger U.S. economy, we will benefit to a degree as the U.S. is our largest trading partner, which means a higher demand for our goods and services. And again, that lower dollar will help that play out.
Now, Byron, will the U.S. Federal Reserve tapering affect us in Canada?
Oh, yes. We won't be able to avoid that. Central banks today will continue to exert a very powerful influence on interest rates as they're very motivated to keep the economy and the markets in positive territory. So I expect that 2014 will see a continued and increasing focus on the pace and the type of central bank stimulus. The Fed's decision to begin tapering their stimulus programs, that will and has increased investor concerns around both the Fed actions and the rate of U.S. economic growth, because the easy money policies have already been priced into stocks and bonds. So I think we will definitely see increased volatility in both bonds and equities. And after all, we did see what happened when Bernanke announced that they would begin to reduce their bond buying program, which was $85 billion per month, and the bond market immediately sold off. I thought that was a wake-up call for many people, as they do not associate losses with their bond holdings. Bonds have basically been in a bull market since 1981, as interest rates have deleveraged for over 30 years. So bonds have just become a risky asset class with the potential for capital losses. And I do not think that most people are aware of this, because it's counterintuitive to their life experience. And I think the Fed is aware of this. I believe the Fed's wind down of its QE, or quantitative easing program, it'll probably be a long, slow, and gradual process. The Fed will definitely want to ensure that the economic recovery is intact and that inflation levels remain low. But strangely enough, there's two challenges regarding growth, and I think they're two sides of the same coin. If growth is too slow, the tapering will have to be reversed. But if growth is too strong, the risk is inflation could spike, and that would be a negative event for stock markets on both sides of the border.
Now, Byron, if the Fed continues to reduce the stimulus program, can we expect Canada's economy to grow independent of the U.S.?
Yeah, that's a good question. I would say that notwithstanding the huge rise in the stock market since the bottom in 2009, and of course the strong performance we had in the second half of 2013 in both the United States and Canada, the problem is that economies and markets around the world, they've become dependent on monetary stimulus to offset the effects of the credit crisis we've just gone through in the last 5 years, since Lehman Brothers actually collapsed. And an important change I see coming is that beginning in 2014, both the United States and China are going to begin to reduce their monetary stimulus. So we will have to see whether their economies can, withstand the cost of higher interest rates. Since, as I mentioned earlier, a similar trial balloon in the summer of 2013 failed, at least from our point of view. So we expect the Fed to keep rates lower for longer to try to mitigate any shock to the system, and they have telegraphed that quite clearly. But at the same point, economic fundamentals will have to, at some point, replace liquidity or stimulus for the economy and the markets to grow. I mean, that's why the rise in equities is more of a function of rotating away from fixed income where the returns are not attractive, rather than because equities represent a real investment in value. So the beginning of 2014 illustrates that point for me. We've had more than $1 trillion that has been lost on paper since the year began. It was the worst January since 2009. But given that the S&P 500 was up 30% last year, it's reasonable to expect some profit taking. Corrections are part and parcel of every cyclical bull market, and we've already seen 12 corrections of 5% or more since the markets bottomed in 2009.
Byron, I have a couple more questions for you, but we're up against a break, so let's go ahead and pause here, and we'll be right back with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and when we return, we'll be discussing Canada's economic outlook for the year. We'll be right back.
More Sound Investing with Byron Striloff after this.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm.
If you're struggling with a dental or oral health issue, be sure to catch the Healthy Smiles Oral Health Show with Dr. Norm Ickard on the Health Channel on localwebradio.fm.
Shopping for the lowest mortgage rate? Looking to refinance?
Catch the Mortgage Newscast with Jared Dreyer
On the Business Channel
on localwebradio.fm.
It's now time for more Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy.
All right, we're back with Byron Striloff. We're discussing Canada's economic outlook and the markets. Now, Byron, before the break, we were discussing some corrections. And are you expecting more corrections to continue in 2014? Could we have a bigger one? And how should investors handle market corrections in general?
Well, I'll tell you, it's often been said in our industry that nobody rings a bell at the top of the market rise or at the bottom of a market fall. So, unfortunately, this makes timing the market a little harder. But let me answer that by telling you a little bit of a story, if from my personal experience, about one of the biggest crashes we had, and I remember it like it was yesterday. That would be October 19th, 1987, which was Black Monday, the day of the first big crash of our generation. And during that day, the markets fell 23% from sunrise to sunset. And unfortunately, it was my first week at a new firm as the sales manager, so talk about a trial by fire. The only way we even knew the market fell was after the fact by watching the news, because we really didn't have emails or computers with the sort of instant communication we have today. But what I remember most about that day, and the following week, was the few advisors and investors that kept their heads, and the many advisors and investors that lost theirs and got thrown off their respective career and financial planning paths. At that time, fear dominated the markets, and everyone had a recession forecast. But strangely enough, real GDP was running at a 6% annual rate, and corporate revenue was north of 10%. So valuations were great in the market, but short-term sentiment and technicals caused a very large correction. As we all know, the fundamentals did win out in the end, and the markets found a bottom in late 1987, and a lot of money was made by investors over the next few years. So I learned a lot from that experience, and that motivated me to start reading everything I could find on investment psychology and behavior. I knew then that my calling was not to find the next stock that will double, but rather to prevent my clients from panicking out of their lifetime financial plan for financial independence for themselves and their families.
Now, Byron, that's a great story. And aside from technology, it's funny how little has really changed in the markets. So what sort of returns do you feel investors can expect in 2014?
Well, returns so far this year have been hard to come by. But one thing is clear. Canadian companies are becoming more willing to return money to their shareholders. BCE just raised its dividend by 6%, and Suncor Energy said they would increase theirs by 15%. So corporate profitability is on the rise, and companies, for the most part, are sitting on a lot of cash. That cash is being used, and I think will continue to be used for things like share repurchases and dividend increases. I think that some of the contributing factors for what we're calling a dividend boom would include growing optimism about the U.S. economic recovery, a Canadian housing market that is still resisting crash fears, and a growing willingness to return profits to shareholders, because increasingly management understands that dividend-paying stocks have better longer-term performance, higher stock prices, and therefore make really for happier shareholders. So almost half of the TX-listed companies pay dividends, and 54% of them raised their payout in 2013. So that's one of the reasons why we have a renewed optimism about interest rate-sensitive dividend sectors.
Well, Byron, once again, great conversation today, but again, we are out of time. So if you, the listener, know someone who would benefit from what we've talked about today, please go ahead and share this podcast with them. I'm sure they'll thank you for it. You can visit Byron at www.byronstriloff.com. That's www.byronstriloff.com. And you can always reach Byron by telephone at 604-535-3700. Again, that's 604-535-3700. Now, Byron, as always, for myself, for the listeners, thanks so much for the conversation today.
Thank you, Erik.
Thanks for listening to Sound Investing.